Good morning, folks. Welcome back. We made it through the week. What an incredible week, especially looking at some of the corporate earnings, some of the shifting in the markets. And looking back to last Friday, the NASDAQ in particular is down close to 3% without posting much of a recovery throughout the week. There's been a ton going on. We'll kind of just focus on basically trying to position ourselves. I heard a really interesting sort of snippet this morning in reference to actually an old book on an old magazine series on quantitative trading that I used to see some of my colleagues read and kind of think like, why are we reading this dusty magazine I've never heard of? But it's a great point. It's something that I've said before, but I'm not going to take credit for, which is where are the bets? And looking at the economy, looking at the market, things certainly appear fairly strong with some of those major concerns floating around, which we hold here. I mean, especially real estate, the debt behind real estate. You've heard us show a lot of concern about that, and we are starting to see like a lineup of indicators that point towards that and justify that fear. Examples being WeWork indicating a going concern warning, meaning that they're not sure they can continue as a business. Imagine all of the sort of WeWork spin-offs, right? I'm trying to think of one like Industrious HQ, and there's actually two in Williamsburg that have popped up brand new. I even bumped into someone on the street who was promoting the co-working space, and it does not seem to be working very well. That said, real estate plays a really interesting role in the economic piece, particularly when it comes down to inflation. I'm going to share with you guys, this is markets. I mean, I was going to start with this, but we can go to our inflation dashboard. And this chart shows the main components of inflation, excluding energy. Shout out to our friends over at AlphaCast. They are an amazing source for macroeconomic data and an incredible team, wonderful people. Very reasonable pricing as well. I mean, I think that you cover a lot of the use case for Bloomberg with AlphaCast, but at a minuscule fraction of the price. We're talking about 1/10 of the price. They have not sponsored this video, but that gives me an idea. So you can see here the components, right? And you see how housing has steadily crept up and is now somewhat on a downslope, on an evening slope. And if we look at actually some states that have outperformed the national average on inflation, housing is a piece that has been within the reach of the government to control, especially when we talk about type Section 8 housing or government housing. They can really play with those costs and prices on their end to help tame inflation. Now, in places like New York, real estate prices are insane, rents are insane, and certainly there's a lot of idiosyncratic components to New York City. Again, if there's one thing you learn in following me in this series, it's the word idiosyncratic and systematic. Idiosyncratic meaning risk specific to that unique situation, to that asset, to that person, to that location. It's risk that's specific to that thing. Systematic risk is risk that encompasses wide swaths of the market. It's something that affects the entire market. If the U.S. Government defaults on it, that's systematic risk that will affect companies, even if companies are well managed. So that's a little bit of an example. But sharing the screen here, we can see inflation plummeting, transportation in particular, be taking a deep dive, but a steep recovery. But overall, year over year, in summary, we're seeing inflation at around 3%, which is really great, coming down from the heights of over 8%. So the narrative of inflation coming down and things starting to go back to normal is coming back. Of course, there's a lead and lag. We talk about this every day. But the market, and now we jump over to the market, is really expecting this soft landing scenario where inflation's dead, economy's roaring, businesses are selling at all-time highs. And in the last week, we've digested a little bit the scene of the economy with stocks, and we've taken away the fact that, okay, our companies are really strong and resilient. So are our consumers. That said, that doesn't mean we're impervious to changes in the market, right? Fewer iPhones being purchased, fewer homes are being built, fewer co-working spaces are being rented. So I think that we are finally hitting that nexus point where inflation does eventually die, but it comes through corporate spending slowing down, business spending slowing down, individual spending slowing down, and cutting costs as kind of, we come to the end of a year where prices were outrageous. Most consumers, at least what we see from the macro data, bridged that gap with some of their credit. And now we're reaching that point where people are saying, okay, maybe I should actually cut back. How long will this last? But it's coinciding with prices actually coming down. So again, I think that we are in good hands with Jerome Powell stewarding this. I frankly can't believe we haven't spiraled into a full-blown recession this year. And I can't believe that the market is up. Here we're looking at Penn. I'll jump back into that later, but take a quick peek at the NASDAQ. Year to date, it's an absurd chart. It's absurd. Uh, you know, Ridiculous performance. At the peak, almost 40%, and now 30%. But going back over the week, we've lost close to around 3% with the unknowns floating around, right? What's going to happen with inflation, employment, tech growth, tech earnings, a lot of mystery. But I do think that AI has been the main buoy here, especially looking at the NASDAQ versus the S&P, because the S&P chart, although it goes in a similar direction, year to date, 15%, NASDAQ year to date, give me a calculation, bud. Well, we know the number, but that's the difference there. Is I think that AI has propelled anything technology or anything AI to a place beyond perhaps where it has earned such a gross return, such an amazing return. So we'll continue to monitor that. We'll continue to monitor the inflation piece for y'all, but the real estate piece is at the forefront of the market, especially the WeWork news. That said, let's see. That's a watch list. Okay, so I want to add WeWork, not an index. All right, so we added we. So this was funny. This is something I was kind of saying among some of my friends yesterday when WeWork collapsed after their earnings report. Was that's a spicy dead cat bounce trade, as they like to call it. A dead cat bounce trade is buying something after it absolutely collapses and then scalping some of the speculators. So in this case, if you had bought WeWork at the close yesterday, you're up 43%. I don't know what the options are pricing in. I'm struggling to break out some of the like nerdy market stuff to these briefings, but I can't imagine what the option activity has been on this company. This is right now the epicenter of risk in U.S. equity markets. Do not touch radioactive, um, unless you want to substitute this for going to Atlantic City and spinning the roulette wheel. But there's just an incredible amount of volatility and unknowns, especially in real estate and the debt that crosses real estate. So with that, guys, I think we've wrapped up the week fairly well. There's almost too much going on to cover it all at once, but I like to keep us focused on what matters, right? CPI came in relatively well. Producer prices also came in fairly well. Prices are cooling. Markets are strong. I think a little overbought throughout the year. I announced it earlier this week. I'll confirm it today. We're going to reduce half of our position in Penn and put some more in cash. That leaves Penn as the lowest weight position in our portfolio. It's also the weakest position, weakest performer. So we're going to cut half of that losing position. Penn now holds only 5% within the model portfolio, and we're in 5% cash right now. It's not super defensive. It's a little more opportunistic. And I think this is something that sort of multi-strat global asset managers started to do this past month in particular was, okay, let's take some of our winnings off the table. Let's reinvest internationally where we see interesting things so that we're not so consolidated. Korea has done great. Japan has done great. some names in India. That's such a deep and tricky market. It's similar to Japan, but I would say even less consolidated in some respect, unless it's Tata, that huge conglomerate in India. That's it, folks. We'll catch up next week. Lots to chop up on the portfolio. I'll update you guys next week as well on the new allocation, which now we're reducing our pen position in half. Pen gaming, especially off the back of the Barstool news, I think there's upside for both parties, but I need to more deeply understand it, especially because that spinning off of Barstool from Penn was not in our thesis whatsoever. So when you invest in something and you're completely wrong, even if you make money, I suggest always taking a step back and reanalyzing and making sure that you're in line with what's going on and your conclusions are well derived. Take care, guys. Catch up next week.